May I start the webinar? Okay, we can start. Fine. Good day to one and all. This is Dr. Sivaraman of iknowindices.com. So I'll be presenting part 2 of Tracking the Forex Market Together webinar. And today is December 4th, between 14 and 14:45 GMT. So in this, it is a simple market tracking technique using the live market code page and a simple trading strategy of using the hedging instead of the stop. And we try to earn consistently from the market by doing either way trades. So I given part 1 between 9 and 9:45 GMT, and I explained there that how exactly we use the statistically derived forecast as a guiding factor. Besides, we do the market reading, note down the initial lows and the highs around 3:30 GMT in 4 majors and 2 commodity pairs, and try to refer those levels to that of the current market conditions. So current market levels are here in the live market code page, and we can just refer to it and find out how exactly the players are making the moves in the market. And market is known to make quick up and the down moves, but during that of the yearly trend reversal time, that is the last month of the year, current year, and the first month of the next year, the market is known to make very big volatile moves, and the reactions for each and every data release and the rumor will be very big. And if you go with it of the sentiment created, and suddenly they can just reverse the market and say that this is a different sentiment. So you should not go with it of the sentiment during this particular time frame, because earlier, during the normal trending time, when the market makes about 20-30 pips move on the upside and the downside, you find that it is related to fundamentals or technicals. But now, even if there is no data release, they can make such moves. And ultimately, the players do this sort of moves in order to enhance their earning during the fourth quarter, and also the increase the earning for the year end. So they will be focusing on that. So we have to find out what they try to do it in the market. Ultimately, in the market, they can only do 2 types of moves. One, a consistent rise or a consistent drop. So if they make a nominal swing on the upside and the downside, then the traders can easily find the supports and the resistance and then try to take the positions. But similar to that of the shift in trading zone, the players make the one-sided gains for a few days and one-sided drop for another few days. So when they do like this, people will try to look for the supports and the resistance and find that it is failing. So go for the next support and the resistance, next support and the resistance, then give up. Then later on, they make the moves what they have envisaged. So this is what you come across during that of the yearly trend reversal time. So when you try to trade during this particular time frame, you need to understand that the players have got the money power and we have the limitations with regard to our equity. And also when you go in for the leverage trading, then once the market goes against us, the platform will try to take away the free margin from our account. So in order to avoid margin call, in order to see that we do either way effective trading from the market, in the market, we need to necessarily use the hedging. If the hedging facility is not available, the simple mechanism will be try to enter into the market whenever you come across quick moves. Whenever you come across quick moves. And that is the most important thing, so that we can trade without a stop and quickly we'll be able to earn money. Now, an opportunity is there because it is a time 14 GMT and 14 to 14:30 GMT will be the gap time. So whatever the move they do it during the gap time, which is considered as a false move, the opposite they are expected to do it for 30 minutes from the start of the session. So keeping that in mind, we will try to trade without a hedging and we will only use the stop and see. Now, This is the gap time, 14 to 14:30 GMT, between the European and the US session. Now, I'll take the positions first and later on explain, because otherwise we may miss. Now, those who have attended the part 1 of the webinar might be able to see that I have booked a profit in all the positions what I had taken. Euro I had taken a sell position, and GBP I missed because before that they had dropped, and USDN they had taken a sell position and booked profit. Now you come across during the gap time, let us refer to that of the initial lows and the highs so that we will easily follow it. Okay. Euro is still trading below that of the initial low, and it has formed a new low. Okay, 35.39 is the new low, and erroneously this particular quote page has shown with regard to Euro this. So it is staying near that of the low. So when it is staying near that of the low for the 10 minutes of the gap time, it has not breached, or about 6 minutes. So what we do is we'll try to take a buy position. $1.3542 with an entry stop or a stop 30 pips below $1.3512. Why I have taken a buy here? Because it has formed the low 1.3539 and did not cut that. And what they do is they make the false move during the gap time. So when they are holding closer to that of the low, and they are expected to slowly firm up and gain during that of the early part of the US session. And later on, they will make a drop. So we can capture it aiming for about 20-30 pips profit. So I had taken a buy position. In the case of GBP, 63.26 is the low, and 63.42 already they have started gaining. So I'll take a buy. $1.6343 with an entry stop or a stop. Okay, I'll just show it with regard to two currencies. So here you come across that I had taken a buy position in the case of Euro and GBP, and I'm expecting them to firm up during that of the early part of the US session. Now, you might be wondering, see, there was a data release, ADP non-farm payroll was released, and it was so positive with regard to US dollar. So immediately Euro and GBP made the drop. So one can think that they could continue to make that drop. But the players are not here to do that sort of thing, and they will try to induce the traders to develop the market sentiment and try to act against them and hit their stops, and later on they will try to make the slide and say that because of non-farm payroll the market has, Euro and GBP has dropped. So you have to smartly identify what they are trying to do it in the market, and that is the most important thing in market trading. So I have taken only two positions here, one buy in the case of Euro and another buy in the case of GBP, and try to see how exactly by 14:30 GMT the US session starts, and we will be having the webinar up to 14:45, and we will try to see before 15 GMT we should be able to see profit in that as a false move gap time trade. Now let me explain to you with regard to the positions what I have taken during the European session. I took a sell position as a technical trade, 1.3580 in the case of GBP, and it went up to 1.36. I kept the stop at 1.3610, and after the ADP non-farm payroll, they started making a And quickly I booked a profit at 35.47 and a 33 pips profit was seen. GBP I missed during that other part one, so I not taken a sell position there because by the time I was talking the data was out and they made the drop. And in the case of yen, I took a sell at 102.61 and they made the drop before that of the ADP. So I found that it is a false move. So 102.29 I closed it and 32 pips profit was booked. And later on they have come back to this. So this is what I told you, that they will make the whipsaw moves between the high and the low, just like that. Take out the stops on the lower side, take out the stops on the higher side. So we will not be able to make any sense out of that. And in the case of CHF, I took a buy as a technical buy above that of the initial low. And then what happened? They went up to 90.64 at that time. Now it has come to 69. And I kept stop at entry and they just filled the stop. So this trade was without any profit. Then in the case of GBP 167.84, I just took a sell position, and 167.41, I closed it, and then subsequently they made a small further drop also, but I was contented with 43 pips profit because I want to close it within the session, and the next session we can enter into the market again. Then in the case of Euro Yen, 139.36, I took a sell position, and 139.05, I booked it, about 31 pips profit. So all the positions excepting CHF were closed with profit. CHF was stopped out at entry. So now, if you understand that if you are quickly able to move stop to entry point, then you eliminate the risk first of all. And don't think that if I keep stop at entry, immediately they will hit and run. It's not like that. When they hit your stop at entry, definitely they will give you a better entry point for you. And suppose my stop at entry is filled and they will give a further higher level to take a sell position. And also I can refer it to that of the initial lows and the highs. And you find in the case of yen, 102.67 was the initial high and they are still trading below that. So we can simply watch, and if they are not going above that, earlier they made a brief upward stop in the case of USD yen. And now you find that they are not doing it. They have come up to that of 102.67 and holding it. So if they just hold like that, we can take a sell position here and they will make a drop and we can book profit of 20-30 pips also. So I just showed only two trades as far as gap time trade is concerned. So these are all the positions what I have just taken based on our understanding. That is, when they set the initial lows and the highs and not breached the initial low and the high for more than 30 minutes, then we try to take a sell position below that of the initial low or buy position above that of the initial high as a technical trade. Otherwise, if the market goes up to that of the high and reverse, we'll take a sell near that of the high or a brief stop and they just go for about 3-4 pips and come below that in less than 30 minutes, we understand it is a stop. So if they stay below that of the initial high for 30 minutes, we take a sell and immediately we'll be able to see that the market, they are able to book profit. So the initial lows and the initial highs are vital. So we have to identify the type of moves in order to take the appropriate trading decision. So let me explain to you the type of trades, how exactly the type of moves will indicate us. Now, before going to the type of moves, we need to understand the market timings, which is very vital. This is the timing followed by that of the big players. And depending upon the bank opening and the closing in various regions of the world, they have this particular time frame. And it is better to track the market using the GMT time frame because for them, this 24 hours is one day. So we should also follow the same time followed by that of the big players so that we'll be able to understand how the gap time moves or false move, how during the session they make the swing and slide or swing and rise. So swing refers to my forecast. It will be during the early session. Then slide means mid-sessions they will simply hold it, late session they will slide. Or swing and rise means swing during the early session or lower level swing and then try to consolidate during the mid-session and late session they will make a rise. So we need to understand the timings. If you remember the timings very well, we'll be able to easily take decisions with regard to the trading because they make the moves based on the timings. So when they make the moves based on the timings, it is not based on the data release. The data release is used only as a trigger, but they use based on the time. And as I told you, is that exactly by 14 GMT, you'll find that they will make the gap time moves. And 14:30, they will start the session-wise moves. So we need to understand how exactly they are following the timings and making the moves in the market. So accordingly, you can take positions. Now, I've shown you the timings. So how we do the market reading? We note down the initial lows and the highs around 3:30 GMT here and try to use that as a reference level. If the market is above that of the initial high, then we do a buy and sell trade there for more than 30 minutes. If it is just around this and making a brief upward stop near the high and not staying above that for more than 30 minutes, we take a sell, we'll be able to definitely book profit. But the ideal thing is today, during the Japanese session, the gap between the initial low and the high was very low. But subsequently, they breached the low and formed more than 40 pips. So any major wherein the spread becomes more than 40 pips, we can initiate the trade. Till such time, avoid taking position there. If you avoid taking position so that you can focus on the currency wherein they have made already 40 pips spread, then you'll be able to easily book profit. If you take a position in a currency wherein the spread is not being formed, then you may have to wait for a longer time in order to book profit. So if you want to quickly book profit without your patience being tested, so the best thing is identify these simple rules. Then with regard to the type of moves, we note down the initial lows and the high. When the market is near the high, we take a sell. When the market is near the low, we take a buy. If we are in the middle level, we simply relax during the mid sessions. We try to take positions during early and the late sessions. And in the crosses, we take positions during mid sessions because they are active during the mid session. Then the type of moves we need to understand. So, a move which is for less than 30 minutes, they go above the initial high and drop in less than 30 minutes during early or the late session. It is referred as a stop point. And similarly on the downside. And if they go up to that high or low and reverse, then it is referred as false move. Then they alternate the intentional move with that of the extended move. Extended move is for a period of 2 hours and intentional move is for about 2 sessions and the start of the 3rd session. So intentional move will be a slow move, extended move will be a big move. So always look for this extended move in order to take positions if you don't have the hedging facility. So whenever they make a quick drop, try to take a buy. When they stop cutting the new low for more than 30 minutes, definitely they will bounce back and will be able to keep stop at entry and book profit. Don't bother about the technical or don't bother about the data release. And there is no guarantee that in tandem with that of the data release, they have to move the market because they can always make the moves with certain excuses and say that the data is discounted, already built in the pricing. Or they can say that people are more worried about the next data which is going to be released. So they can give any set of interpretations and do it. So as such, the data release time, you use it as a trigger time, but there is no need to track it because we are not the experts to give advice to the respective governments with regard to the economic conditions. We are only spectators. But the players somehow influenced us to follow all the economic indicators, economic data release, etc. of various countries. And we indirectly become experts in giving interpretations with regard to the basic fundamental data release, and we try to do the analysis for 1 year, 5 years, 10 years, and track it for several number of years, all those things with regard to technical and fundamental. But we are not able to understand what is going to happen in next 30 minutes. So it is very easy to make a commentary with regard to the market and refer all the past data and just give various blah blah interpretations. But a trader needs what is going to happen in next 30 minutes or next 2 hours, next 5 hours. And if we simply say that in next 5 hours or 6 hours, the market can go up, in the event if it goes up, it can go up to 1.3610. And in the event if it comes down, it can come to 1.3487. Fine. But that trader has got a question whether it will go up first or go down first, so that he can decide with regard to the trade. So ultimately, that we need to find out. And after the move, we can say that it has come to that of the support if it comes to downside. And after the move, I can say that it has gone up to that of the resistance after the move. But was it given before in order to take a position? There comes the importance of the forecast. So ultimately, any forecast, whatever you derive, there will be an element of error involved. So what we need to do is use the trading strategy and use it so effectively so that we can minimize the risk and maximize the profit. So don't purely depend upon the forecast given by anybody for that matter, because every person who is giving the forecast always gives the disclaimer that trading in the market is risky. Secondly, they also advise the stop. So when they advise it, you can understand it can go wrong. So in such a situation, we need to perfect your trading. So my simplest suggestion will be, when the market is stagnant or when the market is not making any big move, you don't take any position just because you have got the urge to trading. But you take position whenever they make a very quick downward move or an upward move. Downward move when they stop cutting the new low for more than 30 minutes, take a position. That is extended move. Always the extended move will be a quick move. Intentional move will be slow move. When they make a downward move, intentional move or an upward move, then they continue to gain and breach the high every 30 minutes or continue to drop and breach the low every 30 minutes. Then if we breach the low or the high after 2 hours, understand they are doing the intentional move. There is no point in taking a buy during the drop or taking a sell during the rise, because they will continue to make the move. So you should be able to differentiate. Whereas the intentional move is always a pip by pip move. Don't immediately think that euro does not have a strength. It is only making a small gain of 1 pip, 2 pip. But actually their intention is to gain the levels. So any level you take a sell, they will continue to absorb and go up. Continue to absorb and go up. So that is what happened last week when they gone up to 1.36 in the case of euro and GBP 1.34. People thought that it is a slow move, so it may not have much of a strength. So they started taking the sell positions and found that they are stopped out by end of the month. And later on, now they are making the slab. So when they make one-sided moves, especially during the yearly trend reversal time, because they have got 2 months to play with, then we need to be very careful and we need to understand what they are trying to do in the market. So we use stop in the trading strategy. Why we use the stop? Because any of the analysis can go wrong and the market can suddenly give a knee-jerk reactions, or it can do the whipsaw moves. And so we cannot afford to hold the positions with endless loss. So we have to limit it, because if it is 30 pips, we will be able to absorb it and earn back. If it is 100, 200 pips, we may have to do 5-6 trades to earn it. And in that process, you become impatient. When you lose in one trade 200 pips, and then subsequently you try to earn, you may earn 15-20 pips in each trade. Then you find that, okay, this way if I do it, probably I have to do the trades for about 15-20 days. Instead, let me take 10 lots and book 10 pips profit. Then the market reverses quickly 20 pips and you get the margin call. So never give importance to your emotions. And emotions will always give the reactions based on the fear and based on the greed. And such emotional decisions may not help you to earn money from the market. And there is a saying, any psychologist, when you ask, any act which is caused during emotion is always false, or always it is an erroneous act. So we have to understand that such emotional decisions are always erroneous. So when you are emotional, immediately don't look into that market and try to drink some water and just distract yourself with the music or whatever it is and come back after 5 minutes and watch the market where it has gone. And anyhow, you have got a stop of 30 pips. So at the maximum, you may lose 30 pips. So when you know that, let the market make any sort of move, but I got to stop to limit the risk of 30 pips so that you will be able to face the market moves. If you trade without a stop, then you find it extremely difficult. Those who have got the hedging facility can use the hedge order to limit the risk instead of the stop. The only difference is if you use the stop, the position is closed. And if you use the hedging order, you have higher level buy and lower level sell positions. And then what happens, you can just reverse the trade, book profit on the sell side, book profit on the buy side. Especially during this sort of yearly trend reversal time, they are expected to make whipsaw moves on the downside as well as the upside. We come across a very clear move in the case of USDN, Euro and GBP. So how they gained quickly levels, how they dropped the levels, we are able to understand. The long-term forecast is different, but intraday you will be able to take very good opportunity in making about 30-40 pips profit. So, but thing is, we need to have a perfect understanding of it. Okay, let me take up the questions which are asked here, and I'll also meanwhile show the trade. How exactly it is faring. At the moment, we find that Euro has made a small dip from here, and it is 14.28 GMT. Okay, so they made the drop during that of the gap time. So now watch for 30 minutes during the session start time from 14 to 15 GMT. So gap time dip, the opposite is expected during that of the session. You just watch, and we have got the stops to limit the risk. And if it is a loss, develop the mindset to accept it. Don't simply say that, no, my decision was correct, whereas the market has moved against me. Nothing like that. We can also commit mistakes. Wine is a question. What is the life cycle of your trades? Okay. Like Euro USD, it took several hours to mature. I would have exited after the first dip, but held on. So as I explained that within the session, I'll try to close it. No? And so I will not be impulsive. I know very well during the early session, we can take position. And during the late session, we'll be able to close it. And we find whether they are holding below that of the initial low, above that of the initial high. Accordingly, we take positions. So once they handle the majors during the early part of the session, then they will come to the majors during the late part of the session. And during the mid-session, they will handle the crosses. If I am trading crosses, as I had done it in the case of GBP and Euro Yen, I closed it during that of the mid session. Hope you are able to understand that. Leonardo, Euro USD, if it is going to go any higher, it needs to break 1.3560 to the upside and less than and above, or else down. Will go to 1.355. Okay, it is your perception, but I go with regard to the gap time moves. Let us see how exactly they are making it. If I am wrong, I will accept it, sir. No problem. In George, I did not understand how no loss, no profit in Swiss. Okay, in the case of Swiss franc, 0.9050, I had taken a buy position because it was above that of 9046, the initial high. So I took a buy position. Then it went up to 0.9064. So I kept stop at entry because the moves are very less. So I kept stop at entry and they just reversed and closed my stop at entry. So no profit, no loss. Okay, Euro USD, if you don't take 35.40 right now, get ready, 35.20 is around the block. Yes, we can improve on it, no problem at all. So because I had to finish the webinar, I had to take the positions. Hope you are able to understand that. You can always watch the gap time move. If they are making a dip, they are sure to make an upward move for first 30 minutes. So we can fine tune, wait for a good move and then stop. When they stop cutting the new low, stop cutting that particular low in the gap time, then we try to take a buy, then they will stop gaining. And Sundram, show your current positions. I am showing the current positions. Then, any. Should we expect USD CHF to rise while USDN is dropping? Yes, they will try to do it because USDN, they come across a major cross, especially Euro Yen and GBP Yen. So those two crosses, a lot of traders take positions. So accordingly, they just made the one-sided gain in the case of Euro, Yen, and GBP last week. So this week, they are just holding around and making some USD gaining, USD weakening moves and trying to build the position, sell positions in them, Euro Yen and GBP Yen. And also, they started handling the European crosses. So they will finally do the big handling or big moves. They will try to make it in the case of majors and also the European crosses in the sequential trend reversal time. So you find that all the crosses are making negative net change, most of them, excepting the commodity cross. Because commodities, they are showing a differential move. So already Aussie has dropped about 121 and actually it was only 10 pips drop from the European session. European session we have seen that 0.0111 and now 10 pips. Longer term forecast. Is it meant in 2014 or further? Yeah, longer term forecast 2014. I gave it during the part 1. They're expected to make the drop in the case of Euro and GBP till second week of December. And then subsequently year end they are expected to gain the levels in the case of Euro and GBP as well as USD Yen. And till second week of January, they are expected to hold high and build sell positions and make the drop for at least 3 months from there. And they will be making USD gaining over that time. So in this month, you will find that early part, you find Euro and GBP at a stronger level. Later on comes to the weaker level during the mid-December, and later on during the end of December, they will become strong again. Similar moves you will come across during January. Okay, Raman. Could you please give you understanding of how the players take out one stop loss? Okay, it is very simple. So they have a specific order during the early part and the late part, and with which they will ask for a required volume. So suppose they want to make a downward stop in here, they will keep a sell order 1.3510 and keep a buy order 1.3530. So sell order will be placed first and buy order will be placed immediately from another counter. So the sell order will expose all the other stops and the buy order will accumulate all the stops and go up. That is why you come across during data release, etc., you find the sudden updates happening. So when it drops quickly, it gains back. When it gains quickly, it drops. So that is because of simultaneous order placement. I can't tell in open place more than that. In MRC, what is it? Exit in Euro USD, take profit in other words. Okay, take profit. Okay, now I have to watch the move for first 30 minutes and exit. That's all. We will not be able to determine the levels. These are all only the gap time trades. See, what happens when you develop a take profit level, you get the mental block and immediately you keep one exit order or the take profit order, and if it is not filled, you expect the market to fill it, but the market might go against you. So the best thing is follow the timings and enter and the exit. We'll be able to really make good profit from the market. Because the levels, they show it in order to trigger your emotions. And if you follow that, you become emotional. Instead, you follow the timings, then you will not become under the influence or you will not be under the grip of emotions. You will be able to easily trade. And once you get rid of the market fear, you find that you laugh at the players. Okay, you wanted to gain, so before that you are making a drop. Fine, I'll take a buy. That sort of decisions you will be able to make. Euro made new low. So Euro just made a dip. Okay, yeah. Okay, 30. Let's come up to 30. But we have got the stop. We have to limit the risk. In lamb, are your current trades meant to be intentional move? No, it is gap time move. Gap time, they are not known to make false move. So if they make a downward move, it is a false move during gap time. Once the session starts, then they are expected to make an opposite of what the move they have done it. At that time, I'll try to exit in first 30 minutes before 15 GMT. Then trigger. AUD New Zealand cross is very interesting. How do you see it? Yeah, and they have to necessarily make up and down moves in the case of Aussie and New Zealand dollars. Here you find that it is 126 pips negative net change. New Zealand dollar was only 62 pips negative net change. So you find denominator New Zealand dollar as less negative net change. So Aussie New Zealand dollar will be in positive net change. What is it? Okay, it is of the Aussie New Zealand dollar, because New Zealand dollar has made lesser drop and Aussie has made more drop. So the denominator is stronger when compared to the numerator. Negative exchange. Okay. So New Zealand dollar has made 60 pips negative net change. Aussie has made 125. So you come across lesser negative net change in the case of Aussie New Zealand. So their relative strength and weaknesses are more important. Then Stacy, is it good to take a sell on USDN as it is around a bit of the expected? Yes, we can take a sell position because it is holding. Still, best thing is wait up to 15 GMT. When they don't go above that of the intermediary high, as I told you that 102.67 was the initial high. If they don't go above that till 15 GMT, 30 minutes from the start of the session, to take a sell, then you will be able to see the profit coming. Because we need to read the intentions of the players, what they're trying to do, whether they want to take it upward or a downward. How the intentions are important, because when all the traders have taken the sell positions, the players want to hit their stops on the upside. When all the players have taken the buy position as a herd of traders or a group of traders, then they make a drop and hit their stops. So they create the market sentiment, act against it of the traders every time to earn money. Then Karthik, actually USD first went down only in 1914 level. Later, no, actually it came up first and later on when it came down. Nominal gain and later on came down. I could stop it. So even if it is on the downside, imagine we have got a hedge at 90.20, and once it is hedged, we can keep stop at entry, and once the stop is closed, when it comes upward, we can book profit. So absolutely no fear, market fear, or there is no need to get worried about such moves. And once you are perfect with regard to your trading strategy. Okay, your comment on the USD index. Okay, as far as USD index is concerned, majority of the currencies contribute to that of the index, especially the majors. And when the majors make USD gaining and the USD weakening move, that is the numerator currencies when they show negative net change, and denominator currencies show positive net change, like here, then it is USD gaining move. But most of the time what happens, they make a contrarian move. Last week you would have noticed that Euro, USDN and GBP are gaining levels. So at that time USDN was making the USD gaining move, Euro and GBP are making USD weakening move. At that time you'll find the US dollar index will not have much of an impact. So as far as currencies are concerned, the US dollar index, when they make USD gaining and the USD weakening move, you'll be able to see the down and the up moves. But when they make the contrarian move, you'll find little impact with regard to the index. And FX, how do you see New Zealand dollar? See, Australian dollar and New Zealand dollars, they are simply holding it. Already they've finished in the commodity pairs the downward move. Now here afterwards we'll find when Euro and GBP are making drop, they will make nominal drop, but may not participate. Similarly, when Euro and GBP show about 10-20 pips positive net change, Aussie and New Zealand dollar might show about 40-50 pips positive net change. And so they have to now focus on the majors, the four majors, and also they have to focus on the European crosses like Euro GBP, Euro CHF, and GBP CHF. So after that, only they will come to the trending move. So till such time, we have to wait for the big moves to happen in New Zealand dollar. That is why, you have to identify which pair they are handling it. And if you watch carefully, I have been telling many times, when the spread becomes more than 40 pips in a given currency, you try to take positions. When in New Zealand dollar, Aussie is not making big spreads, don't take positions. At that time, what happened, they will simply hold it. Then you can find it is not worth taking the position there. Instead, you can take position elsewhere. So ultimately, as a trader, we need to focus on the currency which could earn for you. not simply having a sentiment that I will only trade euro or I am lucky in trading GBP or I am lucky in trading in euro yen and things like that. Instead, which currency will give a trading opportunity? A good trading opportunity you have to identify, and then you will be able to see profit. Okay, FX trend. Why did you take position in the gap time? No? See, the time allotted to present this webinar is the gap time. So I have to identify what trade I can choose. One of the trade is the gap time trade. At the gap time, they are expected to make a false move, and the opposite, they are expected to make it during that of the first 30 minutes of the session. So they have come to the buy level in the case of GBP, euro slightly lower, and you will find that suddenly they will make a rise and book profit. Nothing more than that. So ultimately, what we need to understand, our stop should not be hit. Whenever the peak move is happening, actually, if I would have waited for another 2-3 minutes, I would have got a fine-tuned entry. But I wanted to give more importance to the explanations and show you how gap time trades can really make you profit. Now, that is break even. And now GBP is slightly making profit, and the euro has come to closer to the break even. Okay, no more questions. So, please understand, market is tradable provided you have a perfect understanding of the market. Otherwise, market can continue to give the fear and you may not be able to become successful. Whatever be the size of the equity, whether it is $100 to $100 or even 100K, unless and otherwise you get rid of the market fear, it is next to impossible to consistently make money from the market. Now you can see that. I'm just showing you how they are doing it. Nothing more than that. Okay. Do you recommend any book? Sir, as far as the market manipulation is concerned, do you think any book can give it? They are to be gathered. The informations are to be gathered. Nothing more than that. So, I can give a lot of books with regard to distractions on the technical analysis, and you can go through all the books, and you will find that on certain occasions the market tend to behave in expectations of such bookish information. But consistently it has to make it. Then only you will be able to continuously make money. So after the ADP data, everybody was expecting it will be a straight fall. So there comes the difference. If you follow the time, you will not think like that. Okay, they have to do the false move during the gap time, and they have to make the opposite move during start of the session, and they may gain up to that of the initial low or to the intermediary level, and then start making the slide later on. At the time, if you try to take a sell position, then you will be wise enough. Instead, after the drop, if you try to sell, thinking that the euro will come to further lower level, looking at the chart without referring to the timings, then you find your position is stopped out. Because none of the charts give you the timings of entry and exit. So follow the timings followed by the players. You'll be able to really see trading is an interesting phenomenon. What will be your exit? 15 GMT will be my exit time. Whatever the level they show, I'll simply close it. That's all. So try to learn how to focus on that timing. So every time I have been giving the market timing, people thought that it is my own imagination and things like that. It is not like that, sir. The players follow this for nearly about 25 years. I've been observing it. They have not changed it. So if you follow these timings, you'll be able to really make easily the money. You follow your technical analysis, fundamental analysis, and also use the timing. This webinar is being recorded, sir, so it will be available in fxstreet.com. In a few hours already. Part 1 is available in fxstreet.com under archives of the webinars. Kindly go through that. There you will find the slides. You can make a note of it. Monitor it. So I'm giving for nearly from 1998, 2001 onwards, I've been giving it in FX Street, all the informations. So if you just go through all these webinars and just archives of the webinars and find how every time I'm repeating the same, every time they do the same. And you have to understand the players are making it. They don't have any alternative. They have to trap the traders only by this method so that they can earn money. Okay. So now our trades are in profit. Hero is in profit of 20 pips, and probably I have to wind up the webinar. It is 14:51 because there's going to be next webinar in next 10 minutes. I have to give room for them. So I take this opportunity to thank FX Street and also you people who have come here to listen to my webinar. And I'll come back tomorrow, that is 5th December, and present Asian session live market analysis. So my email ID I have given, my website address I have given it, and Skype chat I have given, and Yahoo chat. If you want to contact me, you can contact me through email or chat. I'll help you out. And it is not a promotion, and it is only to say that I can help you. If you are really convinced, only then I expect you to subscribe. Thank you one and all. See you tomorrow.